Okay, I am crystal clear about what depressions mean typically. Depressions, almost the thing they always involve, unlike the 1970s, and unlike what we've even seen in Japan with kind of zero inflation or deflation, it's the deleveraging of debt and financial asset bubbles. That's when you see a depression rather than a deep depression. Demographics predict deflation or inflation because slowing workforce growth is deflationary and rising rapidly, like in the 70s, is inflationary. So in the 70s was due to be an inflationary thing, and people now still think that governments printed money in the 70s. They didn't. They ran deficits in a recessionary, inflationary economy, duh, but they were not printing money off the charts like they are now. They did print money in 1932 at the end of the first crash because it was so bad, but they printed it like 6% of GDP rather than now. Real quickly, when you print all this money and do all these assets, why do I not listen to the markets? The markets are on crack, okay? Would you listen to a crack addict and ask them, of crack addicts on a roof, what are they gonna do? They're gonna try to fly off of it. The markets have been fed free money. All this money comes in, adds to the financial asset pool. It's not been given to businesses and consumers until just recently with fiscal stimulus. It pumps up financial assets. They're on crack. They're going up. They don't need a good reason. Oh, but they have earnings and the price earnings is not that high. There wouldn't be any earnings because there wouldn't be any economy. We'd be like Japan or worse if it weren't for this constant money printing. Everything is fake and artificial, and the markets are so high they don't know it. Debt deleveraging, financial asset bubbles is detox. It sucks. That's why nobody would choose it. Central banks will not choose it. They're going to blow this thing until they have the avalanche, and then deflation will take over. The economy will heal itself so fast. Income inequality will be solved so fast. Debts will deleverage like they did in the early 30s. 62% of private debt disappeared. That's good. That's a detox. That makes you healthier, even though it almost kills you. So that's the way I see depressions. That's what's unique. And depressions have deflation. Japan's only thing, they had the financial assets deflated first. They never let the debt deflate. That's why they're in between inflation and deflation, and they're going to end up in deflation. And guess where Japan's demographics go? Down again as strong as they did in the 90s. So Japan is going to deflate this time because they're going to go down so hard they'll have no choice. Our markets are going to cause this crisis, and then debt gets restructured because the markets collapse, and the economy cannot grow without these markets feeding the rich, who are the only people still spending money out there. So if you're selling yachts, sell them now because they're not going to be selling very soon. The rich are going to lose the most money when this bubble bursts, not the poor. And for Bitcoin, we had the debate with Michael Turpin a few weeks ago, and I'll just show this briefly. Here's my view of Bitcoin. I think it is, along with blockchain, more importantly, the next thing how financial assets get interneted, okay? The digitization of all financial assets and money, okay? But it's in the early stages. I compare it to the dot-coms and Amazon. The internet index went up great into 2000 and fused it and then crashed. They were the end of the first tech bubble. Amazon did better than ever because it was one of the leading stocks and then crashed. 95% crash. That's my projection. Let's say 58,000 was just the top, and I put out an update to my newsletter subscribers today. That could have been a top, okay? To go down 95% would take it where? 3,000, where it bottomed after the 2017 crash. That'd be the fourth wave. I got a million. 3,000 to 4,000 is my target for Bitcoin. A couple years from now, it is not an inflation hedge like gold, and it is definitely not. It's the worst possible safe haven on this earth because it's the biggest bubble of all bubbles, like the dot-coms were in the last tech bubble. So that's my view. We are in a bubble that is beyond anything we've seen before, more global, more pervasive, all asset classes, almost everywhere. And now the emerging markets are joining in late stage. And of course, crypto and Bitcoin and crazy stuff like GameStop, which showing there's so much money floating around, you're just going to keep bubbling stuff until it blows. Somebody asked me yesterday in an interview, how does this thing blow? I say, you know what? I don't know. Do you know in an avalanche, when that one snowflake adds in, or that one grain of sand on a mound, and then it all of a sudden collapses? That's what's coming, or I'm going to quit my profession. It may be less deflationary, I say, or not, but it's going to be deflationary. This bubble is going to burst, I think, very soon now. It's been stretched so far. They're printing so much now, it's making no difference. What are they going to do next? 10 trillion? And then when we crash, are they going to recommend 20 trillion? And then, but if you go back to that one chart, just in here, where the bonds did better in the crisis, but then coming out of it with the money printing, gold did better. That's where I could see gold in a second stage of this, towards the end, doing well. And guess why I like gold long term? Not because of inflation. As Jim said, demographics say a low inflation, low growth world, even in emerging countries increasingly. Asia is going to be the dominant part of the world on a cycle I have into the next several decades, and Asians love gold. Chinese buy the most, Indians a close second, but Indians as a percentage of their incomes buy way more than Chinese, and India is going to be the biggest growth story of the next 30, 40, 50 years. I would buy gold hand over fist when it hits my $1,000 give or take target. And by the way, that is going to be way less than commodities and silver, way less than stocks going down, more like real estate. Gold is not the worst place to be in the crash. And in fact, you're really sitting there listening to me and Jim say, these both guys sound good. Here's what you can do. 40% short stocks, unleveraged, SQQQ, let's call it. 30% 30-year treasury bonds, and 30% gold, so you're covering all bases. I would just take the stocks and the treasury bonds, you know me. But if you want to do that, that's another way to play it. Deflation is the only way to take out this unproductive asset. We've seen lower inflation with slowing workforce growth. We haven't seen declining workforce growth. Now, if you look at workforce growth, who's got the lowest inflation of the major countries? Japan at 0. Who that? Oh, Europe, 1%. We're average 2%. That's because the differences in workforce growth, and Japan hasn't let their economy slow down enough. They keep stimulating it at 3 times the rate we do to keep deflation at bay. We have not seen deflation. It's going to be the most painful thing we've experienced since the 30s. The stock markets don't know what it is. People don't know what it is, and they're going to get their ass kicked. And the only grace about this from history is it's going to happen so fast, and it's going to change things so fast. We get thrown into crisis, and we end up hopefully doing the right thing instead of just printing more money as if it would work anyway.